Hello everyone, welcome to Just Invest Today, and we have a great video for you guys. Today we're talking about the Nasdaq correction. Man, we are really in a correction. The Nasdaq has dropped like 10%, 11% since peak. Holy crow, 11.8%. So what are you doing now? What are you gonna do in this time? In this video, we're going to talk about what Seth Klarman predicts for the future, what he said in his annual shareholder letter, and what he's seeing in the market and what is going on. He has some good quotes to kind of sift through, look at, and see what we can do in this market. So before we really get into this video, can you please like it, subscribe to my channel? I'm always providing you guys with so much new content, man. So like and subscribe to this channel now, man. So let's get into it. But before we do, man, the Nasdaq has been getting killed, man. Wall Street sell-off deepens. Nasdaq confirms correction. So, man, we don't really get these corrections a lot, man. It's almost like when people are in a bull market, they forget that these corrections can happen so quickly. And this just shows you that value investing kind of puts your mind in a place that you understand your companies and the value of your companies are going to persist for 5 years out in the future. So you can look at this correction as a good thing. Volatility is a good thing. So look at the stocks that got corrected. Netflix, huge hit, man, 20%. And are we going to see this in other stocks, man? Because remember, we have Facebook, Google, we have Apple, like all these earnings are coming out. Can you imagine what will happen if they don't meet their earnings? Holy, we're gonna see an S&P like bear market correction like 10-15%, and that's gonna be a huge shock to the market. Let's listen to Seth Klarman. Let's hear what he has to say. Seth Klarman rings the alarm on speculation, complacency, and inflation in his annual letter. Here are his 11 best quotes. So if you don't know who Seth Klarman is, he's a famed value investor. People said he was called the Oracle of Boston, which is crazy. And we know the Oracle of Omaha was Warren Buffett. I think from 1982, he's averaged like 15 to 20%. So that's crazy. That's a huge return on your investment if you invested in his Baupost fund. Every time these guys come out and have strong talking points, amazing quotes, we gotta listen up because these guys know what they're talking about. They've been in this market, they've been in turmoil, they've been in the ups and downs in the market. So let's listen to what Seth Klarman has to say. Seth Klarman came out with his annual letter for Baupost, and he had these quotes in this article, and this is just eye-opening, kind of to show you what is going on in the market and what he's seeing. We see today's market as characterized by stretched valuations, deep complacency, and hosts of looming risk. That is crazy because when you think about it, yes, there's some stocks that are in that territory of stretched valuations, and people were thinking about this for a while. Going back to Tesla. Tesla is at a 300 PE. There's a lot of stocks at 100, 200 PE like Snow. Netflix is even not that bad at 36 PE, but we know before it was crazy like what these stocks were selling for. So he's seeing this as an opportunity as these stretched valuations are kind of sinking. So with stretched valuations, that brings on a lot of market risk because remember, price that you pay for a stock is super key. It's important to deep value, to value investment, to seeing how much returns are going to get in the future. So that's pretty much a huge risk, and people were complacent. They didn't really care about it because they thought the bull market is going to run forever. So that's his first quote. We believe the mounting inflation and the related possibility of materially higher interest rates are posing a real danger to financial markets. So you have to remember, when there's higher interest rates, banks actually are happy about this, the banks. But when there's higher interest rates, companies with a lot of debt, they're going to have to pay off, they're going to have to pay that interest rate on that debt. And then when you're paying off that interest rate on that debt, guess what happens? You're going to have lower earnings, lower money to spend. Even people who have consumer debt, they might not have as much money to spend as if you're paying high interest rates on different products, on borrowing. So this definitely has a huge effect on the market. So if there's less spending, less money going to GDP, less people buying products, that means less earnings for companies. So interest rates have a direct effect on the market, and people are seeing this as like, whoa, like we should probably back off, especially if bonds are going up or going down. So they're kind of hedging their risk right now. Against a backdrop of relentless money printing, a very active Federal Reserve, and fiscal largesse, many investors have been lulled to sleep, unaware of the unfocus on risk. They are like the cat that didn't jump on the hot stove. So this is what's happening. People are just blinded. They keep forgetting that this bull market is fed by the Federal Reserve printing money, stopping the crash. And as the Federal Reserve keeps printing money, they are actually helping, and they're buying equity, they're buying bonds, buying mortgage-backed securities. This is all boosting the stock market, and people are kind of forgetting this and kind of not hedging their risk when this comes into play. So it's been such a good market for investors that people are forgetting about this risk, and I can even say myself too. You forget about this stuff when the market does really good. And this is why it's so important to have these strong businesses that even if the crash does happen, you can just be safe and knowing that you have these amazing businesses and you just focus on that instead of buying these companies that really don't have earnings or really you don't know where they stand because they were just making so much money. They're all shooting up. Now you're kind of worried and you don't know where you stand with that business. So yes, people were just sleeping unaware because they're just making so much money. The buying frenzy of the past 12 years has lured many market participants in speculative holdings that someday will seem like roach motels, easier to get into than get out. Wow. These quotes are just like hitting, bro. These quotes are hitting. Like, that is crazy when you really think about it. And this quote just brings me back to like, man, a lot of people are speculating, and when you're able to, you can speculate in the market when everything is just nice and clear, everything is going up. T-Doc was going up, Peloton was going up, like all of these stocks were just raging, going up. It didn't matter. You didn't need to focus on the risk of the business because everything was just going up. Everything was printing. Money was coming in. You didn't need to focus on the business anymore because that's what the market was giving you. You knew you didn't have any risk because everything was just shooting up. So this, again, going back to the next quote, people were sleeping. And then you don't know when to get out. You don't know when stuff is going to hit the fan. And now you're seeing people are just running for the hills. That's why there's a correction in the market. And that's why I feel like in this article, he's talking about a big crash. Seth Klarman might be talking about a huge crash coming. So just be aware and just put yourself on notice that this can happen. Number 5, it is said that the bull markets always climb a wall of worry as the cautious are left behind while the intrepid get ahead and the reckless lead the pack. But the opposite may also be true. Bear markets must be inevitably descend a mountain of overconfidence and hubris. 6, we often have success searching through the abandoned property bins of the market. Whew. And that's where value investors love this market, man. And that's what I'm talking about. The volatility that this market is presenting is amazing. I bought more coin at $194 with the growth rate being almost like 100%, like the last quarter or the last year. Like, man, I think this is a huge opportunity. As it is a driver of opportunity creation, volatility should be more properly be considered a value investor's best friend. And volatility is what makes you a value investor. You accepting the volatility and loving it and seeing this as an opportunity instead of seeing this as a bad thing. Because if you're not selling your stocks in next month, next year, why do you care where the volatility is if you're holding it for 5 years and you know the market in 5 years is gonna be back up because that's just the history of the market. As your business performs, the market will correct the stocks that are performing well. They will bring those back up to where it should be at. So you shouldn't worry if you have these good companies. It only takes one moment of overconfidence, distraction, and sloppiness to undo a lifetime of painstaking compounding. Man, that is very true, man. Like, you can have this amazing compounding record, but one thing can just kill you. You have to be anti-fragile in this market, and the amount of money you put into a stock really matters. Like, sometimes people are overexposed to like one company, which could be good if you're that confident, but you have to look at the other side and make sure that the amount of risk you're willing to take when you're putting like 15% positions, 20%, 30% positions, because that one position can just crush you. So just be cautious with that. I mean, like, for example, a company like Google, you can put a 20-50% position if you're confident in the price, because the business, we know in 5 years Google is not going away. So that's a low downside risk that I would have a high conviction for, because we know Google isn't going away. It's going to be here for the next 5 years. YouTube's getting bigger, more people are watching, etc. So you can put that 20% position in that because there's a lower risk of your stock or the company that you own just going bankrupt or getting killed in the market. So you can't be sloppy when you're putting 20%, 30% positions, because that can just literally just ruin your whole investment career. So these are just wise words from Seth Klarman, man. So we should just take it, kind of learn from what he's saying, and just kind of just get our thoughts together while this market comes into a correction territory. So that's it for the video, guys. Please like it, subscribe to my channel, and I'll get back to you in the next video. Peace.